Welcome everyone to episode number 39 of the Wide Lens podcast. I'm supposed to be here joined by my co-host John Sim, but away sick. But I've got Andrew Papageorgiou here of Realm Investment House, who I'll introduce in a moment. But we're going to cover the latest topics in financial markets. We're recording this on Monday, the 3rd of April, 2023 at 10:30 a.m. I've got Andrew here with me, and those of you who don't know Andrew heads the corporate credit and bank capital function within Realm Investment House, and he's responsible for the firm's relative value process, currently managing in excess of $3 billion of investor money. Andrew Papageorgiou, welcome to the Wide Lens podcast.
Thanks, Robert. Thanks for having me.
Hey mate, let's just quickly start off. I just want to give a quick wrap up of financial markets over the last week and year to date. I'll bring this up now. S&P 500 up about 2.5%, Nasdaq up about 1.8%, European stocks up about 3%, emerging markets up about 1%, and then Australian stock market up about 3% over that same time as well. Interestingly, and also Bitcoin up about 3%, which has been quite surprising, I think, for a lot of people over the course of the last few weeks. I'll bring this year-to-date chart up now as well for those same indices. S&P 500 up about 8%, European stocks up about 11%, emerging markets up about 4%, the Australian stock market up about 4.5%. The surprising one for me, and I think for a lot of people, is the Nasdaq up, technically in bull market territory, up 20.83% year to date, which I think is surprising for a lot of people, especially after what we saw through 2022, almost a tech wreck again. And then Bitcoin over that same period up 74% in AUD terms. In fact, having a look at some data last night, and the Nasdaq will go down as the best quarter for the Nasdaq 100 since Q2 of 2022, and it'll mark the 21st quarter in the Nasdaq 100's history that the index was up at least 15% for the quarter, which I think is pretty remarkable. Andrew, what are your takes on that fact with the Nasdaq pushing? And I won't talk too much about equities. We'll talk about a whole bunch of other things. But if we can use that as a segue with what's going on at the moment, we saw the tech stocks get absolutely polarized in 2022 with interest rates going up, duration becoming a problem, and then all of a sudden we've got tech stocks back on again. What do you think is driving that?
Oh, look, I think pretty clearly it's just the old adage that bad news is good news. In regards to the fact that it probably instructs the market that interest rate rises are nearing their end, or that's the view they're taking. We've certainly seen the shorter end of the rate curve start to invert, with bond markets almost pointing towards rates getting cut and cut heavily into year end. So, essentially when you're dealing with assets that really don't have a heck of a lot of cash flow, right? So all of a sudden we went from volume and subscribers and spend to people focused on cash flow again. When you're a business that doesn't make a lot of cash, and instead your philosophy is built around the net present value you're going to create through enhancing enterprise value, where that will be released at some point in the future, 10 years from now, 20 years from now, God knows when. Interest rates are really disruptive to you, because in any net present value calculation, the key discount factor, as well as your weighted average cost of capital, a big part of the weighted average cost of capital is the actual interest rate. So if I've got $100 10 years from now and I've got to discount them by 5 or 6% per annum as opposed to 1% per annum, there's going to be a pretty big difference on the end value of that asset, right? So really the key principal component, if you're a tech investor and you've got assets that are cash flow light, really you take the view that low rates is good, because it allows that very, very simple discounted cash flow to give you a bigger number when you calculate it and you project those forward rates lower.
Is it as simple as that?
Yeah, it is as simple as that, right?
And
it breaks as simply as that the other way.
I was going to ask. Last year, it went the complete opposite way.
Yeah, and who's to say they're right? Because look, just because the market's taken the view that rates turning is or the travails of the banking system are now instructive of rates turning, and that means this stuff is going to start to rally again. The market's making a range of assumptions there as well. So the fact of the matter is, if you look a little bit deeper into the tech market and you look at things like the leveraged loan market, okay, which primarily funds a lot of PEs and VCs buying into these tech businesses, that market is trading in a way that you'll probably describe as being distressed, okay? Look, the big levers, interest rates are a really big lever, and low interest rates support the valuation of so many assets and encourage leverage into so many assets, right? And you saw, I think, we're probably going to talk about SVB today, right? SVB was case in point, okay? The types of stuff you do when rates get really, really low and you have to start to stretch. The thing with rates markets is they inherently have leverage in them.
What do you mean by that?
Well, if you have a 5-year bond and you have a 10-year bond, right, the person with a 10-year bond essentially has 2 times the leverage to the direction of interest rates that the person with a 5-year bond.
Sure.
Now, they both might have $500,000 invested, but as rates move around, the person with a 10-year bond gets those movements magnified. And as rates get lower, what happens is people stretch their neck out. They'll generally take risk in the form of duration, which means they take more length, which introduces more leverage, or they'll take it in the form of credit risk, where they compromise on the quality of what they do. When interest rates get really, really low, what you find is people will stretch for both. And what occurs as a consequence of that, financiers, equity capital market professionals, VC guys, general partners in private equity, they're not fools. If you give them cheap money, they start to find really interesting ways to use it, and then how does that flow through? Well, it flows through into the leveraged buyout market because all of a sudden you can make the maths work around that property and that business and that merger.
The hurdle rate's so low, isn't it?
Correct.
Yeah. And it's almost, from what you're saying, it's almost like investors in the market is overlooking the valley, so to speak, and looking beyond the valley with interest rates potentially having peaked or close to peaking, and now pricing in some cuts. If you want to talk about SVB, I'll bring up this chart in a second. It's funny you talk about SVB's case in point. Henry Ford had this quote. He said, "It is well enough the people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning." I'll bring this chart up of bank stock performance for the last 12 months. And the big ones in there are First Republic, SVB, and we've got Credit Suisse. They've been a dog's breakfast and Credit Suisse has been a dog's breakfast if we're all realistic about it since the GFC. The share price has been going down ever since then. And now we've got Deutsche Bank. Deutsche Bank did start to peel away from the others, but we've come back down again. So we've got some pretty poor performance here for these banks. Can you maybe talk to us about, without maybe going into too much detail on SVB, but give us the bystanders' observations of what happened there. First Republic, Credit Suisse, and now Deutsche Bank's being thrown in the mix there. We've gone from being isolated to US regional banks, let's call it, to all of a sudden over to Europe, and it's not contained there. It's spreading pretty quickly.
Yeah, I don't know that it's spreading pretty quickly. I think you have to look at them all in isolation.
Sure.
First, to correct you, I don't think Credit Suisse have been a dog's breakfast since the GFC. I think you'll see that through the GFC, if you look at their credit spreads and their credit default swaps,
I'm talking about the share price.
They actually performed really, really well. But this is the thing with share prices and book values and stuff like that. You had a narrative of a euro crisis that came after that for the European banks. They all had to capitalise themselves really heavily. It affected the return on interest, invested capital very heavily. And not only that, you moved into negative interest rates, which makes the creation of net interest margin almost impossible. Okay, and it forced them to diversify into all sorts of different things, right? So a bank, here in Australia, we understand what a bank is very differently to other parts in the world. That's the first thing. SVB, very simply, got a lot more cash that it knew what to do with. Okay, you had its core bank, when all was said and done, was $80 billion worth of assets that were used to bank follow-on investment and debt into VC companies and to private equity companies. So basically, their big pitch was, if you've gotten a round A, a round B, out of a VC and you don't want to dilute yourself, we'll give you a loan.
Sure.
And that was about 60 or 70 billion dollars worth of assets. So, from a pure asset perspective, it was under 100 billion, but the deposits just kept flowing. Okay, and they just didn't have the opportunities to bank. So what did they do? They bought government bonds with the actual cash. The fact of the matter was that as a bank with less than $100 billion worth of assets, the regulatory regime that covered them was pretty lax. Basically money goes into government bonds. People can see that these government bonds they have gone from being marked to market, in other words, them taking the price as it moves, to being held to maturity. So that is basically an accounting decision you make where you say, well, we're not going to track this day to day anymore. We're going to basically hold it for 10 years until it matures.
So dollar's a dollar.
Dollar's a dollar, right? Which ultimately, if you believe in the creditworthiness of the US federal government, it is, right? What resulted was people start to track the fact that all of a sudden that mark to market, if it were netted off against their regulatory capital that protects bank depositors, they'd be in a bit of trouble. And even though the accounting, meant that they weren't likely to be triggered, the depositor base basically took the decision of why risk it, and it ran fast. Now, who is the depositor base is the key thing, because basically, if you look through, the people holding those liabilities, there were venture capital funds, there were private equity funds, there were portfolio companies of VC funds, there are individual managers with $1 billion here and $2 billion there. So you're talking about professional investors. When they move fast, and they're just not going to take the risk. Why risk that you're going to get bailed out by the FDIC? So the money ran fast, and it ran for on very reasonable grounds, so that broke it. That broke the bank because essentially they didn't have the ability to maintain the liabilities they needed to support their asset base. It would have led to a wholesale realisation of assets, e.g. AAA government bonds and AAA mortgage-backed securities. And mortgage-backed securities in the US, when you're talking about agency AAA RMBS, they're basically issued by government agency for conforming purposes. They are basically, a very high grade of long duration, long interest rate debt. But basically the value of those assets dropped because of the interest rate movement, not because of the underlying asset quality, but it didn't really matter why they dropped. The reality was that they were, worth 85 cents in the dollar. And if you netted that off against the capital that a bank held, now the bank was essentially in a position where, it had a shortage of capital, right? And then you also had the actual loans, which are these 60 or $70 billion worth of loans that have been issued to venture capital companies that are pretty weak from a cash flow perspective and would be the type of businesses right now that most bankers would be starting to show a level of concern about, given where we're moving into the cycle. So that's the SVB thing. Key lesson there is a difference between a deposit that is insured, that's for $250,000 to a mum and dad. There's a difference with a deposit that's worth $1.5 million to a wealthy private individual, and there's a very big difference to a deposit that's $1 billion to an institution that will run right away.
Yeah, but who distinguishes? It's not as if the FDIC go there and have a look and apply different rules for different people.
Well, in the case of SVB, they didn't, because as a bank with less than $100 billion, they weren't subject to liquidity coverage ratios or any of that.
So let's cover everybody.
Right, but you've got to understand bigger banks are. Right?
And is that what's happening with bigger banks? Potentially, you've got
every one of them is different. Like if you look at the similarities there are similarities between Silicon Valley and Credit Suisse. Okay, the key similarity and the thing that ultimately brought Credit Suisse undone was the nature and composition of its deposit book. Okay, before everything got wound up, the bank's capital ratio was sitting there in the mid-teens. Okay. And you had a liquidity coverage ratio of about 145%. Okay, so what that basically means is they create a runoff assumption around how much money is likely to run off, okay, and you need enough liquid assets to cover that, okay. They had 1.5 times that amount, more or less. But what occurred was anomalous, So I think the Swiss National Bank's announcement there for the 50 billion was on the Thursday, and on the Friday they had 10 billion run out right away. Now, the composition of liabilities at Credit Suisse is also important because you are talking about a bank that is the family office bank of choice, the private bank,
Sure.
right? You're talking about wealthy family money and sovereign money out of the Middle East, out of Asia, okay, and out of Europe. You're talking about not private bank money in terms of his, Mr. Jones, who's been a successful entrepreneur with 5 million. We're talking about his the cousin of the House of Saud, and he's got 3 billion there. Okay, so they press buttons and the money flows very quickly again.
No one's lining up outside the bank anymore.
No, exactly. And this is why, the CEO of Credit Suisse was talking about personally having discussions with depositors and feeling encouraged because you have single depositors with that much money that can hurt you that badly, right? And this is essentially, this is the Swiss banking franchise. They bank the world. They don't just bank Switzerland, okay? So they can't protect themselves when things go wrong. Because essentially you've got all these liabilities from all over the world banking these assets. Now, as a bank, Credit Suisse, we think of it as being enormous, but it's a $500 billion balance sheet, right? So it's smaller than your big four over here in Australia, for example. But, when you say Credit Suisse, look, they all went through the European crisis. Credit Suisse hit the European crisis in better shape than most of their peers. It had been a really well-run bank going to the GFC. DNA started to switch beyond that, and essentially the types of mistakes they did make showed the fact that essentially it was an absence of risk management, and we're talking about what happened with Greensill, for example. We're talking about Archegos, which was the hedge fund that they funded that lost them billions. That's real drop the ball type stuff. Okay, and the bank hit this crisis with a liability base, okay, that's very concentrated, with a business model that was now under question. So it wouldn't be a stretch to say Credit Suisse were facing similar challenges to what AMP were 2-3 years ago, where they had to reimagine what they were. Okay, they were going to have to spin out the investment bank. They were going to have to clean themselves up, and they really wanted to focus on core wealth. Okay, their core wealth private bank. They became non-viable that weekend because how can you be a core wealth private bank when none of the wealthy families or groups globally have any interest in dealing with you, right? Because you're a weak credit now. Okay, that's what occurred. So with Credit Suisse, in effect, their business model became non-viable by that weekend. Okay, their way out disappeared. Okay, you could patch it up. You could provide another 50 billion of liquidity. You could patch it up, but how would they work their way out of it the moment that their business model died? Their business model died on the operating theatre that weekend. Right, it's as simple as that. DB, very different animal. Right, Deutsche Bank, very different animal. Almost the mirror image of Credit Suisse. Hit every branch on the way down they could through the GFC, covered themselves in no glory through the Euro crisis as well. They had a sister bank in Germany in the name of Commerzbank that also had its own issues and ultimately relied on the German government to take equity in that entity, right? But DB today is, this year, is a profitable bank, 5 billion odd euro, very different compositionally. Right, like they're from a risk management standpoint, they have taken a very, very conservative approach to rebuilding their bank, and from an investor standpoint, deposit-wise, very different. Okay, so what you've got is a large chunk of insured deposits. Okay, you've got a very small, high net worth private bank. Their private bank is more akin to what would be accustomed to here in Australia, and then they've got a large set of corporate deposits, but a lot of their corporate deposits are actually operational because their biggest customers are the large German multinationals who they are banking, and they have FX lines with, swap lines with, and the cash has to stay there in many cases for operational purposes as well, right? So from a credit person's perspective, DB got tested because the CDS, or the credit default swaps, which is the instruments used to insure Deutsche Bank's debt, widened materially. After the couple of days after the travails of Credit Suisse after the announcement, and people took that as the market testing for the next touch point, the next weakest link, so to speak. So it was them, it was the likes of SocGen, it was the likes of Barclays, it was banks that had a few misdemeanors in their history, had an element of the bank that is more investment oriented. So I think the difference between Macquarie Bank and Commonwealth Bank, for example, right? Banks like SocGen, banks like DB, banks like Barclays have have an investment element to it as well, an investment banking element to it that sometimes might expose them to risk. So it was speculating going the other way, you know. And DB held up. Like, the reality is that after a period of stress and strain that saw, in particular, their tier 1 and their hybrid bonds underperform, DB sort of held up. And I think we had a chat with their investor relations team last week, and as they rightly pointed out, they're no stranger to crisis. They, the reality is, they've faced issues and question marks on multiple occasions over the last decade, and the reality is that right now, this set of questions has probably hit them in better shape than they've ever been.
That's interesting, actually, hitting them better shape than they've been. For those...
post-crisis.
Sure.
Say, yeah.
I've just brought this chart up for those watching. US, this is from, again, ironically, from Deutsche Bank. US banks today are more liquid than in 2001 or 2008, and UK and Euro area banks' tier 1 ratios are 2 to 3 times higher than pre-GFC. So we find ourselves with banks having... in much better shape than they have been in the last 20 odd years, and Deutsche Bank having fought this war off and fended off investors. The comment you made before, which just struck me when you said they all need to be treated individually, clearly the banking system as a whole is in much better shape. What's next, and what does this mean for the banking sector in Europe, in the US, and maybe we'll talk about Australia later on?
Yep.
Are there going to be more tests that these banks have to go through?
For sure. So, from a regulatory standpoint, I think people will look at the failure of, Credit Suisse and think about the appropriateness of those liquidity tests and how they can be adapted. I think the run-off assumptions around very, very big deposits probably aren't strong enough. So what you might find, the regulatory response might be that if you are the type of bank that has Uber-type deposits that are unconstrained and can leave, you might find the run-off assumption around those deposits is higher.
Gotcha.
Which means you then have to keep more liquid assets to offset against them.
Yeah.
Because in banking, that's how it works. You can have really flighty money, but then you can't be stuck in loans that are illiquid. You need to be able to have assets that can be liquidated to meet that runoff, right? So I would imagine that runoff assumptions would be rerun there. Within regional banking in the US, there are no rules for banks under 100 billion on the liquidity side of things. What you're going to see is there's a different set of rules if you're one of your GSIBs or your global systemically important banks and domestically systemic important banks in the US. And then there's I think there's four pillars depending on your asset base.
Sure.
I think 100, then 100 to 250, 250 to 500, and then 500 above. Don't quote me. There might be 750, and then 750 and above. But what you might find is that you get a normalisation of sorts, which benefits bigger versus smaller. Okay, because what it then does is it might force smaller banks to maintain an asset base that is more balanced. And that might not necessarily be a bad idea, because you talk about the banking system is in great shape, but there are hotspots, right? So, there is a lot of talk at the moment around the concentration in small US banks around CRE, right? So real estate loans, okay, to the lower quality part of the real estate market. There's, from the top of my head, from memory, I think it's about 68% of that market is funded by small US banks. Okay, so what you've had is the bigger Main Street banks, and even the mid-sized ones, avoid this risk, and you've had it all find its way to the part of the banking system that is under the least amount of regulatory scrutiny, right?
Perfect combination.
Well, so this is where, these banks, the total dollar amounts are amounts that the US system can absorb very easily, right? But what it says to you is the level of compliance, the burden of compliance, the burden of regulation around your largest US banks, your largest European banks, right, is up here. But the system is finding a way, and the system is finding a way in roundabout directions. One of it is, they use small banks to fund themselves. Hey, they use the non-bank sector to fund themselves too. We've seen the emergence. Have a look at the market cap of Blackstone and KKR and all these other companies. Have a look at how big they've become and think about the role they've played in banking the part of the market that can no longer be banked in Main Street.
Because of regulatory constraints.
Because you have to keep more capital. Because remember, banks are focused on two things. One is net interest margin, but the other one is return on invested capital. Okay, so if you think about Australian banks, for example, I can basically write $100 million worth of mortgages at a low LVR. The capital value or the actual risk-weighted asset weighting of those assets might be as small as 20 million. And I then have to keep 10% of capital against that. So I can keep $2 million of my own bank equity to fund $100 million worth of mortgages. And if I earn net interest margins of 1%, it's a massive return on invested capital. That's what banks are focused on. Banks are focused on stretching their capital as far as they can. Some of these assets have very large net interest margins, but they're very capital heavy. So the banks just don't have an interest because they might need $100 of cash to fund $100 of risk. Even if the net interest margin is 9%, off that home mortgage, they're making 20s and 30s or whatever they're making. Okay, so what happens is that money finds a home, that other money comes in to actually find that yield. Okay, and for the most part, that's been the non-bank system. And when I mean non-bank system, I don't necessarily mean the non-financially regulated system, because many of the investors end up being regulated. Insurance companies become very big funders of this stuff. Pension funds are very big funders of this stuff, right? So that's where it ends up hitting, you know. So the risk is being carried there. Okay, it's being carried in little spots. It doesn't mean the risk isn't there. The bank's being safe doesn't mean there's no risk anywhere. It just means the risk's not in the banks to the same degree as it was. Okay? That's what people have to come to terms with. You know, but people, just our muscle memory is stuff's going bad. Where's the bank that breaks?
Yeah, and there's a couple of things you said where the sensitivity changes with, you know, your deposit base for certain banks. They might have to hold a bit more cash, or the quality of their deposit
Liquidity of the assets
change.
Yeah.
What does that? So my first question is, what does that mean for return on equity for those banks? I mean, are they now in a position whereby the risk is? I mean, risk and return, you can never run away from that fact, right? So if we're telling these banks they have to reduce their risk, could that potentially mean that we're now eroding potentially some return on equity there as well for some of these banks?
For the smaller banks?
The bigger banks?
Well, the bigger banks, you know, they're already very heavily regulated. Okay, so the requirement for these GSIBs, which is globally systemically important bank, which Credit Suisse was, right? These guys might have, in terms of all their various forms of capital, might have as much as 17-18% of capital, right? So for every $100 they lend, they have to have $18 worth of money that can absorb loss. That's a lot for a bank. Okay, so this figure has increased.
Yeah, I'm looking
significantly.
Yeah, it's back in 2008. If we look at the UK bank Common Equity Tier 1, you're sitting at 4% and a bit.
Yeah. So
and now you're sitting at 16.
Yeah, and there's two sides to that, right? So that percentage is on the risk-weighted asset weighting, not actually the total assets. But the actual amount of risk-weighted asset weighting has also increased.
Yes.
So there's been a double multiplier. So that number doesn't even do a great job in actually explaining just how much capital is there.
Yeah.
So the banks have been buttressed. They've been firewalled. But it doesn't mean the risk isn't in the bloodstream somewhere. Okay, it's like a balloon. You press it, it goes somewhere else. We can see there's plenty of cash around. The money's flown around all over the place. Okay,
and see, that's the thing. You know, we've always talked about higher interest rates, and everyone's focusing on what the impact is going to be on financial markets. Where's that next crack? Where everyone's looking for the next explosion. I don't know how many people were talking about the likes of an SVB or these regional banks. I mean, that was just, while we're all focused over here, this thing's happened over there. Yep. And to your point, once you squeeze that balloon, that's where it's gone. And all of that has been driven by interest rates. And for those watching, I'll bring this chart up now. This is, I think, from Bianco Research. It's showing the expected terminal rate, US terminal rate, and the current Fed target rate. And now we're seeing a convergence whereby the current Fed target rate and the terminal rate have met. Now, you made a comment before, Andrew, where you said we're probably at the peak or the end of the rate hike cycle.
No, I said the markets.
The market.
The markets are
that's what
estimate that's where we're at.
what is your point of view of interest rates, of inflation? Because this is the thing this is the first domino that fell, right? This is what started the whole thing. What's your take and observations on interest rates as they relate to the US and as a consequence Australia?
It's not a domino. At the end of the day, when rates are low, people will do things that people will stretch, okay? And really smart people will stretch. And they'll stretch because when smart people stretch and they do things they know they probably shouldn't be doing, they think they're just going to do it for a very short amount of time, right? That's how they excuse themselves. They go, geez, it's tight, but there's so much momentum and I need returns and I'm being compared against everyone else and I'll just stick my neck out for a little bit, So really smart people get caught out doing really stupid things for what they think is going to be a very short amount of time, right? But that's how musical chairs work. Sometimes
it's like when your mates tell you to go to the bar, just have one drink. Just one drink, no more.
I've never been misled by my friends like that, Rob, but we all choose our own company. So yeah, look, it's going to put strain and pressure on the game that everyone's been playing, and the game that everyone has been playing is leverage in its various forms, right? I think people need to understand leverage more broadly than how they understand it in Main Street, right? In the real economy, where you think about leverage as in, you borrow money. You can just introduce enormous leverage within portfolios, within P&Ls and balance sheets, just by selecting certain securities. Right, like we gave the example of interest rates earlier, a 10-year bond versus a 5-year bond, a 30-year bond versus a 5-year bond, a 10-year bond versus a 5-year bond as a trade, where I then leverage that 100 times, okay? So this is where the system gets to. You start to see a proliferation of what are known as basis bets, okay? Now, what a basis bet is, and I don't want to lose everyone here, but a basis bet might be something like, I can buy a 10-year bond, I can buy a 3-year bond. But what I can also do is I can buy a 10-year bond and sell a 3-year bond, right? And now what I'm betting on is that the yield curve is going to steepen, right? Is going to invert. So I start taking these bets between these 2 points on the curve. But because I'm buying something and selling something, when I net these two things together, hey, right? I'm square. It looks like I have no interest rate risk. But what have I been left with? I'm left with a leverage bet between those 2 points on the curve. And then because that doesn't move as much as the bonds do, I lever that up a very, very, very long way, where I might have bought $1 million worth of the 10-year bond if I was investing in that. I might put 50 million in the bet between the 3 and the 10-year bond. Okay? So people start looking for grains, right? They're starting for little kernels off the ground, and they start taking what look like very, very safe bets in hyper-leveraged form, okay? So, trades that hedge funds like, sometimes they love to speculate into AAA RMBS with a lot of leverage, or into a lot of bank names, bank senior, but with a lot of leverage. And what are they doing there? They're backing their ability to add some value by picking the right direction of where credit spreads go or interest rates go, and they lever that bet, to the point where it now has nothing to do with the original asset.
Yeah, that's interesting.
You've turned it into something completely different.
Yeah.
That's the type of thing you're going to do when rates are at zero and you have to deliver returns. That and a myriad of other stupid things, right? The thing that is most apparent to all of us is, you're stretching for risk, right? No one needs anyone if we're all just going to sit in cash at the end of the day, right? We're all trying to pick the types of credit risk we want, the type of game we want to play, how we want to play it. Like for us, we invest in mortgage-backed securities and asset-backed and, bank tier 1 and corporate debt and all this other stuff, right? Like we make a conscious choice to move away from sitting there at no risk in cash.
Sure.
Okay, and then, we need to take a view around where we want to position ourselves and why, okay? But what we always have to be aware of is the amount of aggregate risk we're actually taking. You've got to be very honest with yourself in terms of how much leverage you're layering into a portfolio.
But see, that takes discipline and patience, where unless you've got some protocol and methodology around what you're doing and why you're doing, to your point before, you can get lost very quickly and very easily.
A lot of people don't understand the risk they're taking, right? It's only when you actually see that margin movement and see how much money you've lost that you realise, wow,
how did that happen?
It's scary, but people going through this for the first time would be learning on the fly, right? Bad things can happen really, really quickly. And the reality is a lot of the time when it happens, you don't you don't see A, where it came from. B, you could never conceptualize how bad it could get, because we do tend to think in a normal distribution type pattern. We sort of think about a normal movement being X to X. You know, when cash rates were at near zero, someone telling you they're going to get to 5, you'd sit there and tell them they were crazy, right? But if you'd been around long enough, you knew it was possible. You might have thought it was unlikely, but you'd never say never, right? The problem is when people go that next step and they say never, right? They say never, and they set their portfolios up and they position themselves in such a way that says never. And when never actually happens, it makes things break very, very badly in a very, very ugly and disorganised fashion, you know. So this is where this stuff can happen. You know.
The whole never thing is something that we should have learnt over the last 5 years for something that shouldn't happen, should never happen, has happened every time for the last 5 years. And those comments remind me about a conversation we had a little while ago where we talked about investors looking at things in absolute terms, in binary terms. This is going to happen or it's not going to happen, and then set their portfolios up in such a way that reflects their point of view, rather than looking at things probabilistically or in a way where, hey, what if I'm wrong? What if my point of view does not eventuate and this crazy person's point of view does eventuate? What's going to happen to me? And, you know, we talked to a lot of investors who make binary decisions. I'm either all in or I'm all out, or I'm investing in this one thing or I'm investing in that other thing. And to me, it feels and sounds like the risk that was built up when rates were so low, the opposite is now happening when interest rates have gone the other way.
Correct.
And it feels like in this conversation we're having is that those interest rates are basically at the core of everything that's going on, because everything is based off that.
No, I mean that's exactly it, right? So, and here's the thing, right? Like the interest rates might have a longer lead time hitting Main Street, hitting the real economy, but have a look at how quickly it's hit Wall Street, right?
Everything prices it adjusts so quickly.
It adjusts so quickly, and you know there's a heap going on over there. If you look at the CMBS market in the US in terms of how they're not reimagining, but you know you've got a lot of assumptions when they were doing CMBS, which are commercial mortgage-backed securities, which have commercial property sitting in them. When you had those securities get run in 2016, bonds that were AAA are now trading at 50 cents in the dollar, right? That sounds familiar, right? But the assumptions they made around where occupancy would be, the assumptions they made around the ability to index rent, and the assumptions they made around where interest rates would be, drove a cash flow model that ultimately has ended up being completely errant. Okay? So this is the whole thing. If you rerun it now and the cap rate's not at 4, it's at 8.5 for a good solid B grade office building, and occupancy is not at 85, it's at 70. And significant capex is required to even hold it at 70. And your indexation, you might be able to index, but you've also got this issue where it ain't about NPAT anymore. It's about free cash flow. So now we do care about the incentives you've provided. Right? We do care about incentives. We do care about the net, not the gross in terms of where your rental yield is. Okay? And you've got a significant amount of that commercial mortgage-backed security market in the US, okay, trading underwater. And you've got some real meaningful concerns around parts of that market.
Can we talk a little bit more about that, actually? AFR had this article, Why Super Savers Should Be Worried About Commercial Real Estate. And the article basically talks about the US commercial real estate market. You touched on it before, where you've got a lot of these regional banks that have provided debt to and finance to these properties.
And private equity firms through CMBS structures and stuff like that.
Now, you've just described that in the US. And there's a lot going on. I mean, there's these other headlines, which are, and I'll just read a few out for those watching. You can see them. These are all from the AFR. Why office values could tumble 20%. Could a US credit crunch torch property here? Fears of office crunch overblown. Charter Hall. Where the banking crisis goes next. There's duress out there, but Dexus boss ready for property pain. Property is sleepwalking towards its biggest test since the GFC. So we're seeing and hearing all of these headlines at the moment. A lot of that has to do with these unlisted assets not pricing as frequently as public markets do. But I mean, they're unlisted, and so...
Well, listed market gives you a hand. I mean, the listed market is telling you where the adjusted cap rate and where the NTA is. Yeah.
So we've got all of this as a background. We've got investors buying up these assets, hoping for full occupancy and all the things that you've just described. But now we find ourselves where these properties have not transacted, they have not been revalued. Yes, the public market is giving us a pretty good indication of what they should be. And we've got all this going on in the banking sector. Can you just maybe give us your take on what that means maybe in the US, which, and without sort of jumping to conclusions here, I think it's slightly different to how it operates here in Australia, but then what that means for Australia. I'd love to get your take, because investors are reading this stuff out in the papers, not just the AFR, and it's potentially clouding or their decision making. But yeah, give us your take on it all.
Yeah, look, I'm not. I have no dog in this fight outside of the fact that we have some REITs that we fund in the high income fund. In the US, the assets I'm talking about, the single asset CMBS market, where you have one, and you would have seen this in the news. This is the American Mall. Or there's another mall out in the Everglades that's trading rough at the moment. You're talking about single assets that might have been valued at 600 million in 2015, 2016 that are now struggling to be valued at 150 to 200. There's some of these retail mega malls that are really struggling. Basically, the capex and refurbishment has been a real issue for a lot of these assets. They're very big parts of the American market where big chunks of CMBS pools have not been refurbished since before 2001. Okay, so you've got assets that might have been B-grade assets that are very, very quickly sort of dripping into C-grade assets that are finding it hard to actually maintain their occupancy. But this CRE type, the real estate loans we're talking about think the lower quality part of the market. Don't think REITs. Don't think...
Now we're talking about the US.
We're talking about the US here, right? We're talking about, middling to lower quality assets. Very often, a lot of concern here. You've read the articles there around Brookfield and Blackstone being involved in certain trusts. Sometimes within these CMBS trusts, the valuation just drops well below the loans, where they just hand the keys back. They're struggling to meet the refinance hurdles that they need. So you've got a number of these CMBS structures that will fall due to refinance this year, where they won't refinance and they'll extend them, so they'll miss their call dates. But there's, qualitatively speaking, there's no question that the lower quality assets are going to be disproportionately affected by this. The only problem is that those lower quality assets are also the ones that are being funded by that smaller part of the banking system and by the non-bank system, right? The larger conduits where there's a portfolio of higher quality loans, we're not talking about the same type of experience there. So we've got to first and foremost distinguish between better assets and lesser assets, okay? So lesser assets will be disproportionately affected by what happens in the United States, okay? And there will be write-downs, there will be realisations, there will be workouts. Banks will be incentivised to restructure, but owners of the assets will need to tip more capital in or hand the keys back, okay? And that'll be a thing. It will have attitudinal impacts, okay, to the market. It has already seen cap rates rise materially in the US, okay? That might have a read-through to our market around what a fair and reasonable rate should be for a shopping centre, for an office block. It's hard for us to pretend we're not on planet Earth and we should still be paying 4s for assets, 4.5% cap rates and rubbish like that, in an environment where cash rates have sort of approached and surpassed that, and in the US they're at 1.5 times or 2 times that, okay? Beyond the quality, I'll say there's another difference, whether it's North America or whether it's Europe as well. So another story that you haven't mentioned there is Aroundtown, which is a very, very big German diversified property fund. Their senior bonds sort of traded at 50, 60 cents in the dollar as well. And they're one of these large European issuers. The other big difference between us over here, and let's just talk about our bigger part of the market and REITs in particular, our REITs are nowhere near as heavily geared as them, okay? And a lot of that is because of the rating methodology.
What are we sitting at? What are they sitting at over there?
Our REITs will sort of sit there on a look-through basis at around 30% for a triple B plus rated corporate. They'll be at 50 to 60, Okay,
Yeah, right.
They're allowed to carry more gearing because generally they're bigger and they've got better diversity.
Sure.
Okay, because around town we'll have offices in London and Frankfurt, and if you're one of our names over here, you're in Australia.
Yes.
Okay, so you get taxed because of that. I think for us that are Australian, understand these assets, and actually feel better about the fact that we are we are beholden to this very stable economy over here, where you've got pretty reasonably rational office markets across the eastern seaboard, right? You think about Melbourne, you think about Sydney, you think about even Brisbane there, you're talking about office markets that, they wax and wane into oversupply and undersupply, but for the most part, they're reasonably rational. Even from a retail standpoint, we're not over-mauled over here, right?
Sure.
So in the US, they had that massive issue over there with all their malls, but they just had a coverage rate per capita that was off the charts. It certainly doesn't compare with where we are over here, where we have, again, you've got your hubs, and then you've got some smaller suburban malls, and they're generally designed to service a portion of a certain number of population that sits around them, and they're well calculated in terms of the catchments they serve. So in terms of the underlying fundamentals, very, very different. Okay, I'll say that. The quality over here is better than the quality over there, or Europe, no issue there. Valuation's still a question, though. There's still a question around what you should be paid to hold that risk. I think that's where the market's sort of running ahead, and it's making an adjustment. All right. The other part of it is in terms of development financing and things like that as well. IRRs change. You can't sit there and promise someone an IRR of 10 and 11 and 12 when they can essentially buy, the credit of one of these companies. They can get 6 or 7% buying the debt of a triple B plus or A rated REIT. Okay.
That starts. You start talking about equity and debt now. And so what decisions do you make as an investor for what proportional uplift you get in equity versus what you would be otherwise getting?
You're more reliant now on the equity giving you upside through revaluation, not through income.
Is that going to happen?
I don't know. You're the property guy. You tell me. But I'd rather take the bird in the hand, so to speak. Yeah. So, so something has to move. Now, when that moves, what it means is the leverage ratios might be a bit higher than they currently were as well. Okay. Now, the thing is we've got headroom. Okay, we've got markets that are rational. What you find is there's a supply side response all of a sudden. All of a sudden the hurdle rates for that asset go up, so you have less assets getting created. And all of that, what it does is it enshrines the value of existing assets. Correct. As long as there hasn't been enormous oversupply, right? So that's how I'd sort of see the Australian experience slightly different. But nonetheless, I think cash, even though we're talking about rates dropping again and blah, 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 remember, if they drop, they'll drop for fundamental reasons. They'll drop because the economy is in really bad shape. And I think people like to just look through the fundamentals and, just say, low rates. Low rates, why? Low rates because unemployment's where? Low rates because inflation's where? And it's broken things, and now, we have other problems. Where's finance? Is finance available? A bank's banking you. Rates could be wherever, but if the banks won't bank you,
doesn't matter what the rate is.
To you? Yeah, exactly. If the big private equity companies aren't raising money out of pension funds and blah, 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 they're not funding to buy this stuff or create this stuff. So that's basically, the picture you're looking at. Rates are going to make cash flow more important, and they're going to make more people focus around the net than the gross. And what I mean by that is, don't talk to me around what your cap rates are before you give 30% incentives. All right? There's incentives sometimes. They could, they're mind-boggling. Sure. And CapEx is bigger sometimes than people appreciate. You do a building for a new for a company, and they're in there for 10 years, and then they go and you have to pop in another 200 million now to take it from a single tenancy
to multi,
and to and there's 150 million that has to get dropped in. You amortise that out. You can amortise it, but when it seems to be recurring, people should ask the question of what's CapEx and what belongs in the P&L as an expensed line, right?
What we're seeing in public markets at the moment in real estate, where it appears as though that has bottomed out, and we've got this uplift now. Could it be at all possible that private markets, when we talk about these office buildings that have not transacted and valuers don't have any basis to apply to their valuation process, and I don't know if they can go and use public markets as a proxy for private markets.
If you weren't afraid of the number it'd give you, you would. If I told you, give me a valuation there, you'd go and you'd look at what an A-grade asset trades at on the most liquid exchange in the country, and you'd work backwards, wouldn't you? I mean, you could, unless you didn't want to.
Well, and I wonder why they don't want to. There's probably an array of reasons why they don't want them to be valued. But could it be all possible if you don't have to have it valued, you don't have to sell, you don't have to transact? Yep. There's no reason for it to be valued, and potentially, again, talking about looking over the valley. Yep. The private unlisted market could also be looking over the valley, so to speak, and say, well, the asset's worth this, I don't need to sell it, so I'll hold on to it for another 12 months, and this is what it's worth.
So what's going to become key there is your debt service coverage ratios. Sure. Okay, so you've got to be able to model a range of outcomes around your DSCR. Okay, if your debt service coverage ratios are under 1.5 times for that property, you're in distress. It's as simple as that. Right, you can't revalue your way out of that one. Okay, so if your DSCR is under 1.25, you need a restructuring conversation because you're probably unbankable. Okay, so debt service coverage ratio, again, don't just look at EBITDA. Look at EBITDA minus capex. Okay, that's what I would do right now. I'd go EBITDA minus capex. That number. That number's the thing that's covering me. So yeah, you can look through the valley if you've got the cash flow to take that mark-to-market valuation. You're absolutely right. Your bankers, they will look through because bankers know there is absolutely no upside.
100%.
No upside in margin calling the market. Okay, and look, from experience there, I think we were together for a period of our careers there at National Australia Bank in 08 or 09, 2010, where I think a lot of people were hanging off the back looking for a 1993, 1994, early 1990s redux, right? Their next big at bat. This was the one. But on this occasion, the banks played it a lot smarter, right? They got their borrowers through. They helped them to get them through to the other side. They provided a degree of forbearance where it made sense, okay? And everyone did better as a consequence. No question. That's the playbook. Okay, so the playbook's not going to change this time. You're not going to sit there and see wholesale, assets getting thrown out where they're already being banked. Okay, that's the benefit of being part of the system. Okay,
and if you're bankable to that extent, presumably there's, again, this emphasises that the distinction between high quality, A grade or B plus grade versus your B, C grade properties.
Your weighted average lease expiries, all that stuff's going to matter.
Yeah, and presumably those that are being banked by those higher quality assets are going to have someone in their corner trying to see them through, and maybe those that couldn't be banked by a much larger institutional organisation with a B or C grade, there's probably reasons why that they weren't being banked there.
Maybe the other guys just paid more for the asset.
Sure.
So when we talk about private equity, we're not talking about them buying bad assets. We're just talking about them being willing to pay a lot more than everyone else for good assets and then leveraging them to where they leverage them and using financial engineering, whether it be CMBS or whatever it is, to be able to get those transactions away. A lot less prevalent here in Australia in terms of, you don't have those mega groups necessarily a long way into property over here because, what we've got is we've got very stable hands when you think non-bank over here. We've got an Australian superannuation system which has SGC, has an enormous asset base and has no issue with asset liability mismatching. It's not like they need to come up with the money and actually pay margin calls or draws or,
Correct.
Unless people start to actually change their behaviours and have a look at the composition of an asset base and say, hey, there's a lot of private assets there. I wonder whether I'm carrying them at a fair value. We've seen no sign that Australian investors can show that level of quick decision making where they can switch out into listed markets to game that, right? But that could create an issue if that behaviour was to start to become prevalent. But there's no sign of that, and let's be frank, it's not going to happen. So when you're talking about the bank system, it's super prime. When you talk about the non-bank system, you're primarily talking about retirement funds that again have enormous amounts of cash. They have more cash coming in all the time. And they have no pressing need to price the asset exactly where it needs to be today to pay out. And then who's left? What's left? There's property at the margins. There's a lot of stuff in the private markets and stuff like that, where it's well held, sold by family money. It's where the assets are well understood, where that outside the bank market, outside the pension fund market. If I were a betting man, I would say that if you're likely to see instances of poor risk management, poor risk controls, and the need to meet an asset liability mismatch more presently, it's going to be in that part of the market, right? But ultimately, if you have to, you're going to rely on the value of the collateral. And if the collateral has value, and if it generates a level of cash, which allows you to find new money to refinance it and move it forward, look, you might be okay. Okay, you might be okay. But make no mistake, as soon as an asset class becomes less bankable, it gets a lot harder to run and bad things happen because essentially you now just can't find, you can't get refinanced. You hit that refinance cliff. And generally speaking, that's when these things go broke. That's when they, not go broke, but that's when they have, that's how you suffer a default event. It's generally around refinancing. It's not on the repayment. The repayment's not a big enough number. But when this asset that's worth 30 or 40 million comes due and now you've got to refinance and it, the bank's done a revaluation on it, or your occupancy's dropped to 70 and all of a sudden they won't give you the X at the top.
So what happens there? You've got let's say a family group that's developing that, for example. They either they've got to have to tip in their own equity.
Yep, correct.
But if I'm just thinking about the whole equity debt distinction, if you're the financier and you're holding the debt, presumably you're in a much better position than if you're holding the equity on that particular transaction.
To each their own. Frankly, I think most actual debt guys would have no interest in being involved in a lend where you're going in there.
Oh, of course, 100%.
With a question of what do I do here? Question is, look, I think that's fair. I think you'd rather be at the top of the stack than the bottom, because at that stage you can actually start to take a view around the asset. You can look at around how you can minimise your loss in the event of default. Okay, so I think that's fair. But by the same token, I think you probably don't need to be anywhere near the shoreline, so to speak. You've got to be looking at the economics of the project. Are you banking projects that are just moving into double digits, or are you banking projects that you can really believe in, because that IRR, that's the first wedge. The ability, even if there's cost overruns or whatever, the willingness of the sponsor to stand behind that project is key. Okay, they'll stand behind a good project, right? When these debts they're limited recourse or non-recourse, where they can essentially hand you the keys back and say, sorry,
that's a problem.
It adds a problem.
That's a problem.
And with a lot of these things as well, the inflation environment has disproportionately impacted these types of businesses, right? Because liquidated damages is what it is. It comes from the bottom, right? It could be anything. It could be, we found this bogong moth over here in this, and now we have to do this environmental study, and now we need more time. And time really hurts project financing. Because you're looking to get to the milestone where you can get that asset to the point of bankability, and you can get that cash out, which refinances him and gives the equity person the money they need to follow on. And the best protection is that it's a good project. Best protection is that it's a great asset. And then you want a counterparty and a sponsor that has the ability to fund that great project and the great asset if it doesn't go exactly to plan.
And see it through, right?
Yeah, exactly. And that's why when you sort of talk about development and industry funds, for argument's sake, at the end of the day, they have good money to go after bad if they have to.
Yes.
Right? So they're hard to break from that perspective, if not almost impossible. But for smaller private investors and stuff like that, where they might be stretched, so your DD has to be on the underlying issuer, which is ultimately the person you've lent money to is the development company and the developer. Okay? The asset is the collateral. Okay? You don't want to have to take security over the collateral. You don't necessarily want to complete the development either. Ultimately, you've got to buy the developer and their vision. Okay, and I'm being very open here. It's not a part of the market that we invest in within our own private fund, because A, it's highly specialised, and B, I feel sometimes it can be a page 5 risk. And what I mean by that is, we prefer mortgage-backed securities and asset-backed loans and things like that because it's on the front page. So basically, if mortgage-backed securities are suffering, they're suffering because unemployment's up to 8 or 9%, and it's an everyone problem. Right? It's
not just an isolated problem. Yeah,
and then what happens is you have treasuries start to engage AOFMs and RBAs and APRAs to create a response which provides a level of forbearance and support to the system, which sort of provides you
I understand.
with that insurance policy as a worst case. When you've got the Deputy Building Commissioner of New South Wales deciding that they want to change how you get occupancy certificates, yeah, it's big news, but there's no bailout for that. That's on you. That's a you problem.
Yes.
So for us, we like us problems. We like to know we've got company. There's certain times where you really don't want to be part of the herd. But when damage is being taken...
You want to be part of the everyone.
Oh, you want the numbers of households affected to be 100,000 or 200,000 or 300,000 because you're a financier to the economy, right? And these are real people, they're real lives. And ultimately, I also take the view that the people that work for government are people that are doing it for the right reasons, right? They're sitting there and they're actually worried about the underlying families and how they're being affected and whatever else. So, we've just always been a lot more comfortable being a provider of finance to the aggregate.
You know, that's a really interesting page 1, page 5 risk concept you talk about. But also then what's clear about that is that the rate of return that one could expect from that type of risk is different to a page 5 risk.
Sure.
And I think it's also...
And the term there you're looking for is idiosyncratic risk.
Idiosyncratic risk.
Yeah, so systematic risk is the risk of the system we all take. That'd be worth X.
Yeah.
Now I'm taking this very specific risk over here, which is extra and additive, and it doesn't have a perfect correlation with this. So I should be paid this over and above what I get for system
100%.
risk. Yeah, for sure.
And that also goes back to what we were talking about before about people making binary non-probabilistic decisions whereby I'm either going to go all in here or I'm going to go all in there.
Yep.
Whereas, and I'm maybe we'll wrap up on this, like how should investors be thinking about allocating capital in this market environment now? I don't think it should be binary, but I'm curious to know what's your take on that.
Look, I wouldn't provide
Not advice.
guidance to anyone. Like, people should look at their own circumstances first and foremost. I think I think that generally gets thrown as a throwaway line, but I think there's a time in your life to be very conservative and very careful. There's a time in your life where you've got the time to recover things, and everything is relative, right? So that's that. If you were purely looking at it from a market standpoint, though, look, our view is what's in the market, what's the market price giving you? Okay, so right now, certain asset classes, you're receiving a high level of implied volatility, a high level of compensation for the risk you take. You have to then reconcile that against the new fundamental risks you are taking. Okay, if the high compensation you're getting is a function of the fact that the risk environment has materially changed and fattened your tails. So the chance or the probability of something going really wrong has gotten higher.
Is higher, yes.
You should be getting paid more, right? But when stuff starts to sort of get a little bit busted, you find that, rising tide floats all boats, and, the opposite is true as well. So let's look at Tier 1, for example.
Sure.
Right? So Credit Suisse, when they did the deal with UBS, one of the decisions that was made was to bail in their hybrids. Your Tier 1.
Yeah.
17 billion got turned to zero. Okay. The Monday after the market came in, everyone's sitting there and going, well, what's a hybrid? What's non-viability? Blah, blah. I mean, these conversations that we're having now are the same conversations I very clearly remember the market having in 2011, in 2012, in 2013, even 2010. We've been having these discussions since we all went to the new Basel III methodology around Tier 1s. But it's almost like everyone was awakened, and all of a sudden people were talking about esoteric risks, and what if there was a cyber threat, and that could be it, and and all of a sudden you start understanding that some of these risks are additive and they're not correlative, right? There's not a perfect covariance. So while people are trying to figure out what the heck is going on, they're selling the credit. Like Credit Suisse has gone to nothing. They start hunting the banks that are next week. We'll sell our DB, we'll sell our Barclays, we'll sell our SocGen, usual culprits. Mistakes get made, they generally get made over there. But they sold their Westpac. They sold the Credit Agricole. They sold the Nordic banks. They sold the Dutch banks. They sold the American. They sold all the banks. Okay? So, Westpac's Tier 1 went from 280 over US 5-year treasuries in the middle of February to 720, 730 over. Okay? So the probability of non-viability assessed, if I can take that credit margin, not the total interest rate, the
Just
total
the
interest
margin?
rate at that
Sure.
stage was 11 or 12% to buy a Westpac hybrid in US dollars, right? 730 over times 5 years, okay, that's the better part of what? 35, 37%, 36.5%, 37%. So the probability of non-viability you were receiving in pure terms was about 36 to 37%. Is that actually how concerned the market was over Westpac's non-viability or CBA's or ANZ's? Well, no, because when you look at their book values from an equity standpoint, they're saying something very different. But what it's saying is this is a market that doesn't know where it is, where it's lost sense of the corners, okay, and it has become completely disoriented. So when this stuff happens, there are wrinkles. There are opportunities that avail themselves because the market becomes generally disoriented, okay? And that's where I think if you've got your head on the swivel right now, but you've got to pick your fights, pick how you're allocating capital, and be very careful, because there are spot fires that we're not done, right? We're not done by a long shot. And we don't know rates. You know, the futures markets and oil markets are giving their own statement around where they see interest rates evolving to. They might be wrong. You know, we might have further to go. There might be new things that break. You know, hand bone's connected to the arm bone, right? Those small US banks bump into the slightly bigger US banks, or that private equity fund hits into that, or, you know, we don't know. What we know for a certainty is we don't know, okay? So you've got to pick your risks very carefully, and you've got to make sure you're being compensated enough for them, right? And it's very important. Again, this is where I think financial advice is absolutely important. You've got to be able to relativize those decisions to your current circumstance and situation, and make sure you're taking measured risks that you as a person can handle, okay? There's not, you know, it's not all in now and the smart money's doing this and I'm going in as well because I'm smart. You know, smart guys do dumb things all the time, right? So, you know, it's a time to sort of lean on the advice and manage your risk as a client. Financial advisors need to manage their clients' risk right now as well, right? Yeah, markets, there's value everywhere. But, you know, things get cheap, then they get cheaper, and then they get cheaper, and then they get cheaper, right? They can just keep going down. They can keep hurting you because, you know, what is 3 standard deviations? That number can be one number today, be a much bigger number
100%.
tomorrow, right? So, yeah, be careful, pick your fights. And, you know, I think at the margin, like from our fund's perspective, we're picking risk, and we have picked some foolish positions in certain areas because we think there's value there, and we think the fundamental risk is being heavily overpriced. But, you know, there's a lot of bottom-up work going into us getting comfort around the fights we are picking right now. So that would be my not advice, but that would be a gentle suggestion.
I think the disclaimer of, you know, everyone needs to personalise this to their circumstances. You know, we it's a throwaway line. We all say it, but it is genuinely true in every word that everyone needs to look at their own circumstance. I think what's also incredibly difficult is for investors to be experts in all different asset classes, to try and assess, you know, some of the opportunities that you're talking about, some potential private opportunities, public. People as a full-time job can't even do it, let alone, you know, the everyday investor, or whether you're high net worth, non-high. It doesn't matter. I think you got to get good advice in different specialisations. And you don't go to your GP for every problem. If you've got an ear issue or a nose, you go to an ENT specialist. You go to your surgeon. Specialisation, I think, has become incredibly more and more relevant now, but also as it relates to diversification, portfolio management. I mean, you could have just gone and bought your stocks and your bonds 20, 30 years ago, and maybe that's all that was publicly available back then. But now we're seeing more and more different types of investment options become available now. Not only what used to be available to only pension funds and ultra high net worth families are now becoming more and more available to the everyday investor as well. And so I think diversification and non-binary decision making is something that investors need to look at. I know you tried to sort of brush off my question to you before, but are rates going higher, or are we done?
I think in the US, I think they genuinely need to get on top of inflation over there. And, you know, look, some of the numbers that I look at that sort of colour my view, you look at the total level of debt outstanding, and you look at, you know, the Congress's budgetary office there came out with a report around where US debts are going. Okay,
isn't that don't you inflate your way out of that?
Well, let's see how we go. Let's see how we go when you're at 30 or 40 trillion US dollars, and you're paying. So right now, what's happening at the moment is the weighted average cost is sort of going up by about 30 basis points a quarter. Let's say we get to 3.5. Okay, let's say we've gotten to 40 trillion now, and we're paying 3.5 or 4% on 40 trillion. It's 1.6 trillion a year. So what that is, that's more than they spend on healthcare, which is right now the largest item, expense item. They spend 700 billion on defence, and they spend $1 trillion on social security. So we're going to get to the stage where, right, if this thing gets to where it's going, and inflation remains at a point where the market expects rates of 3s and 4s, and the Fed is not buying these assets, for argument's sake, just for a moment, we could have an interest bill of 1.5, 1.6 trillion. We could need a significant amount of additional capital to fund treasuries, right? So the technical around treasury starts to become problematic as well, because when all said and done, you can inflate whatever you like, but you still need someone to buy more, right? To fund you, so you can maintain your defence spending and your social security spending and all the rest. So what it then does, it puts pressure back on the budget. So in technical terms, in real terms, you're reducing the debt by virtue of the fact that you've decreased inflation, but there are these technical factors as well. And as we can see, when rates sort of remain higher for longer, it has a really heavy fundamental impact on underlying asset values, on money creation and money supply, and so on and so forth, right? So, the Fed haven't hidden this. They've said from the start inflation is our priority. Okay, I think if they feel like the risks to the banking system are contained, which they seem to be for the moment, okay, what you then find is that they have the flexibility to continue on the road they're taking. I don't think they're lying. I think it is data dependent. I think if it starts to soften off faster and you start to see a response there, OPEC overnight just decided they're going to actually maintain supply as well. So something like that straight away takes away the momentum you've had around energy prices, for argument's sake. If you start to see a demand-side response and you start to see a weakening in prices more broadly, some of the housing numbers around dwelling and rent-equivalent dwelling prices start to soften as well, you could then make the argument that they're in a position to come off. Okay, I think they would love to come off this tightening bias as soon as they can. But also, they are being very, very clear around the fact that inflation, managing inflation, getting it back towards the lower end of the range is the priority. Inflation swap markets, okay, break-even rates, the inflation estimates we're getting from bond markets where people are betting on the actual number, right, which is a lot better than what economic forecasters might say an inflation number might get to, is in the mid to lower 2s, okay? So the market is reasonably convinced that, that they're on the right track, okay, that they might have done enough already, okay, and that as things start to sort of play out and the lags come through, they might have found they've already done too much. Okay? So that's the view the market's taking. Hey, you've already done more damage than you thought. Look at SVB. It's only a matter of time before you start cutting.
How are they supposed to control you and I can talk about this stuff forever. How are you supposed to control that when you've got 90% of US mortgages fixed for 30 years? Yeah. They were locked in 2 or 3 years ago, sub 3, sub 4%. These people aren't refinancing. They're not selling their homes. These people have got mortgages now. It's only the new mortgages that will be impacted by the higher rates. But you've got a big proportion of 90% of mortgages at the moment in the US that are fixed, sub 3%.
Yeah.
So interest rate hikes
means a different thing for them than it does for us, but their economy is very different than our economy as well. And you can look at bank assets, right? Look at our banks. Basically, we're an economy. We were off the sheep's back and now we're off the mortgages back, right? Like everything is off the home. Even if you're a small businessman,
100%.
Yeah, you're taking your title in, right? And you're saying, I'd like to redraw on that and start my business, or everything comes back to the home loan. And it's a floating rate market, which means, it gets IV'd straight in, right? So the base impacts on people's household P&L are a lot more immediate. Okay?
And so what does that mean then for us in Australia, where you've got fixed rate mortgages? Everyone knows about this, the fixed rate cliff coming in June quarter, second half of 2023, beginning of 2024. That, to me, seems like a very obvious thing, but what I've learned in my years, and I'm sure you know as well,
those assets are already done. But yeah, you're right.
Yeah, and so what it's something that's so obvious that typically the most obvious thing is not the thing that breaks the, it's not the straw that breaks the camel's back, but it seems like such a big issue. Everyone's talking about it. And it doesn't appear as though there's a solution for this.
Is it a problem that needs a solution?
Well, if you've got people that have got mortgages at 1.9%, 2%, 2.2, coming in at 5.5%, 6%.
Yep. So what does that do to them? If it hits them hard enough where it creates a pocket of arrears, okay, and remember, those fixed rate mortgages were a very big part of originations in 2021, but when you look at them as an aggregate across all mortgages outstanding, right, they're not enough in their own right to break the system, but it's a meaningful number, right? And it also coincides with a lot of first home buyers, a lot of people that are younger where they're engaged in things that help the economy, like household formation and expenditures on durables and all that stuff. So you will, without question, see higher stress among that cohort than other cohorts. But here's the thing, and we don't like to talk about it, but the RBA put rates up so people go into arrears, so their disposable income reduces, so there is a demand side response on consumption, which then impacts prices and allows inflation to drop. This isn't a side effect of what they're doing. It's the intention. Okay, so when people talk about this and this will affect those people, that's the point.
That's the whole point.
The whole point is that arrears goes back to normal and probably above. Probably a bit above where it has been historically. And without question, when you look at the patchwork, it will be different this time, right? It won't necessarily be the investors, right? Investors are actually holding up really, really well from an arrears standpoint. It will be first home buyers. It will be smaller dollar balances, so because interestingly, the work that regulators have done, and what we can see in the loan pools when we cut them apart ourselves, is the people with more debt are also the ones that are furthest ahead. Okay, so when you look at it from a
in repayments,
so your top quintile, the 20% people with the most debt, are also the ones that are furthest ahead. Okay, so you don't have a situation where the biggest loans and the most leverage are the ones in the greatest amount of distress. What you have is people that are in quartile 2, quartile 3, loan to value ratio 80 and above, smaller value home, right, where the stresses are hitting.
Were they always in trouble to begin with?
Well, they're never that far ahead anyway, right? Not to say they're living hand to mouth, but their buffers are not significant, right? You've always got, 15, 20% of them that are living on lower buffers and are very heavily reliant on their income to make ends meet, okay? But equally, smaller dollar balances in terms of the amount they lend. They're not the $750,000, $800,000 loans. They're the $300,000 or $400,000 loans at an 80% LTV. We can assume that in many cases they may be first home buyers. That group, that cohort there, will feel the brunt of arrears a lot more than the other groups, okay? And because of their relative age, because of what it means around affordability and the ability to own your home and all the rest of it, it will really flow through, okay? And at the same time, don't forget, if you're one of the young people that doesn't own a mortgage, now you're walking into a bank and you're having to justify rates of 8.5% to find money, right? Which is very, very difficult as well, And again, this is that whole impact of interest rates coming through it and doing the damage that they are supposed to be doing.
It almost sounds like just it's a different tune, but similar song to what we were talking about before, where you've got a distinction between good quality, high quality, low quality, poor quality. And maybe, and again, we can only assume that your first home buyers, your lower borrowing, in dollar terms, have bought assets that may not be in prime areas, may not be a prime asset, and therefore a distinction between A grade and B grade assets in that respect as well.
Look, I think in a broader crisis, funnily enough, those A grade assets can be where you hurt yourself the most.
Because of the dollar term?
Yeah, the dollar term, and also the valuation. That's where the value, that's where you're going to go 300 over reserve or 400 over reserve, where you're going to do something really stupid. So if you think about the stress that didn't really push all the way through in 08, 09 here in Australia, but the concern was that banks would let people go. That your upper middle class set that had their $300,000 or $400,000 outstanding, that had suburb hopped, right, gotten their, invested in their social standing and in their postcode, they were the ones that were most at risk, okay, because they were heavily leveraged to the service sector. They had large levels of debt, and now they were out in the open, okay. This time around, it's very different. At the moment, you don't know how these things evolve and how much worse they can get and whatever else. But, the funny thing is that good jurisdictions turn into bad jurisdictions, and bad jurisdictions just stay bad. So for example, when you sort of look at arrears by state, states like Tasmania, states like South Australia, their arrears always trend higher than the other states. But what you find is the thing that impacts arrears the most is a change in your circumstances. Okay, so if you were fully employed on $300 a year and you lost that job and you can't reclaim a role at a similar level of compensation and you're now taking 150 or you're driving an Uber for 80, that means a lot more than you becoming unemployed when you were on 60 or 70.
Sure.
Because your ability to find re-employment at a job at 60 to 70 is very, very, is very easy. You might have a lag of 1 or 2 months, okay? You don't need to be 20 months ahead, 17 months ahead, whatever you are. When you do have that $700,000 loan, where you've got a couple of kids in private school and you've got your car leases and blah, 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 okay, and you lose that $300,000 job and now you're back to 100, 150, you're at risk. But the positive thing for these people is they're that far ahead, okay?
They've got time up there.
They've got buffers. Yeah. They have their buffers which allow them to get re-employed, okay, and get themselves back into the zone they need to get to. So that's why my level of concern would be a lot higher if the threat and the risk was around that group, okay, because they're bigger dollar balances, okay, and that's where it has the ability to really drive contagion.
And as we sit today, it doesn't appear that that's the case according to RBA data and bank data.
Well, look, we get loan pools directly for all the warehouses we invest in and also all the public RMBS, and we get line by line and cut them, and we can not only see where arrears are, we can also see where missed payments are tracking. Okay, because arrears and missed payments, which a lot of people don't understand, are different numbers. Okay, so we can see how many people are sort of lapsing into missed payments and who those people are. Okay, when we break them down by cohort, and that starts to actually paint a bit of a picture in terms of where the risk sits. And it's fair to suggest, given how missed payments are tracking, that arrears are going to rise in these cohorts, right? The aggregate number, is it going to get big enough where you have a systemic concern, a page one concern? No. Right now, it's engineered. It's going about as well as the RBA would want it to go.
Yeah,
right?
that's
Given
interesting.
how far rates have risen, if someone had told you people are going to be borrowing money at 5.5%, if I told you that in Q1 2021, so no one
You're
would do
insane.
5.5%, they're all going to go broke, right? We were talking about, a neutral cash rate, in a lot of people's opinions, being at 1.75 to 2. Well, it doesn't look like we're in recession. Where's the cash rate?
Yeah.
Okay, so none of us saw this, right? Because I think all of us would have assumed if cash rates got to where they've gotten to, we'd be in a situation where we'd find it very, very hard to be able to hold on. Now, that being said, COVID provided households with enormous savings buffers.
100%.
Right? And they'll eat into those as well. Okay, they'll eat into those while interest rates peak and then turn. So from an interest rate standpoint, again, because it is a much more direct line into people's P&Ls and has a bigger and heavier demand side response, okay, on the Australian consumer, I would expect that we're in a position where we probably turn the other way, okay, and actually start to pull back sooner than is the case in North America, okay? And no doubt, given the last inflation number, we're talking about maybe Tuesday being the last one, right? Before we then start to look at rates decline. And if it's not the last one, how many more is a reasonable question for people to ask at this stage, right?
Last question. We holding, raising or cutting on Tuesday?
Internally, we're all mixed. It's interesting because we have sort of surveyed ourselves internally as well, and there's actually a reasonable spread, from 25 to 0 to even 15, even to a smaller hike.
What's your answer?
I think we've got one more in us. It'd be interesting, but perhaps not a full number.
What are we going, 15?
Yeah, maybe 15.
15. All right, here we go. Heard it first.
Yeah.
Andrew Papageorgiou punting on a 15 bips tomorrow morning, but this will be released after the fact, so we can edit it out if you got it too wrong, mate. Thanks for joining in, everyone. Jump on Spotify, YouTube, and LinkedIn. Listen in. Andrew, thank you so much for joining us, and we'll catch you next time. My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526 798. The information contained in this podcast by me and or our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.